Okay, so a little bit about myself and Becky today. So I think looking at the attendee list, I've spoken to quite a few before, but for those that don't know me, my name is Dom. I'm the head of finance here at Goodwill and look after the team that deliver our finance services to our clients. And I've got Becky with me as well. She's one of our senior financial controllers. So alongside looking after our own portfolio of clients, she's one of the leads on our annual accounts and corporation tax services. Um, so yeah, perfect for today's webinar.
Yeah, morning everyone.
Next slide, please. Thank you. So I think I see a lot of clients on the attendee list, some new ones as well. So it's a refresh for those guys, but also if you weren't aware of what Goodwill do and who we are. So we've been established for 26 years, helping clients enter the UK market. We help our clients buy a range of services. So just going over a high level, a few of those. And we have our governance team, which is headed up by a chartered company secretary, and they look after the risk and compliance side and incorporation. And we have a HR team that look after the life cycle of employees. So if you've got any hiring queries, straight away from looking at employing somebody with contracts of employment right the way through to staff policies, handbooks, or exiting that employee, then our team can help there. We have a payroll team. So I guess closely associated to our HR team when you've hired somebody. We help with the HRC submissions, pension administration, and getting the employees paid. Our fourth sort of department that we offer to clients is a virtual office. So typically it's telephone answering service or acting as a postal or trading address if you don't have one in the UK. And finally is finance. So that's mine and Becky's team. And it's where predominantly most of the VAT work sits and also all of the annual accounts and corporation tax work sits. So obviously, but what this webinar covers is sitting in that finance team. Thanks, Nancy. Next slide. So a high-level agenda for you guys. We won't spend too long on this slide. We'll just dive straight into the detail. But we're just going to look at what are annual accounts and corporation tax and also audits. I should imagine it's very similar to sort of your home countries that you're in and where the business is already established. But we can obviously cover that off in any UK nuances. A process flow with a timeline and what the filing deadlines look like for the UK. Some things to consider and important things to know. Also, some regulatory change on the horizon. So recently there has been some bills passed through our local government, and they will be coming into effect fully by definitely the next couple of years. Some changes are already live now. And then finally, looking at some VAT compliance. So I think if we dive in, Becky's going to talk to us about the annual accounts, tax and audits.
Thank you for the introduction, Dom. Yeah, as Dom mentioned a little bit earlier on, I sit within our finance team here at Goodwill, and I play quite a big part when it comes to the annual accounts preparation, when the year end rolls about for our clients. So yeah, I thought it'd be quite fitting for me to join the webinar today and just take you through a little bit of an overview as to what they are, just the real basics there, why they're important, and just some key things to consider as we go through that process each and every year. So I guess starting with the why. So in the UK, you might hear them called as your annual accounts, your financial statements, your statutory accounts, whatever terms thrown about, they together with your corporation tax return, they make up the once a year, the sort of key reporting, financial reporting and tax obligations for your company. So the purpose of those being not only, I guess, to report on the financial activity, but subsequently to allow us to calculate your corporation tax that's payable on hopefully, the profits that have been generated that period. So as the slide sort of alludes to there, the contents of what goes in your statutory accounts is ultimately determined by the size of your company. So there's different sort of levels of framework that you may need to adhere to. Generally speaking, I think smaller the company, less information you're going to need in those. The bigger and the more your company grows, the more information, put simply, that Companies House are going to want within those. So starting, I guess, at the very bottom, you've got terms you might hear: micro entity, FRS 105. That's typically the smallest, kind of most limited set of accounts a company can prepare if it meets certain turnover thresholds and whatnot. I'm going to sidebar that one completely though, because there is a restriction on that, which I think the vast majority of you on this call, you're going to be UK subs of larger overseas parents. So even if standalone, your figures are below those sorts of thresholds to meet the microentity criteria, you are restricted from filing under that sort of category, being part of an overseas group already. So I think for most of you, you're going to fall into the next category, small company regime, which the term you'll hear thrown about is going to be FRS 102 1A. And we've just got some criteria that you need to meet to, I guess, to be deemed a small company. So as long as you're meeting 2 out of 3 of these each year, you can prepare under FRS 102 1A. So the key things to remember, I think they're similar to the audit thresholds actually as well that Dom will touch on shortly, but you need to have turnover of 10.2 million or less, balance sheet value of 5.1 million or less, and an average number of employees of 50 or less. So if you're meeting at least 2 of the 3 of those, then you can fall within the small regime. And essentially what that means is it allows you to make use of certain exemptions and reduce disclosures in that set of accounts that goes to Companies House. So when you get to that year end, you'll typically prepare 2 sets. One will be your full accounts. They always have to be submitted to HMRC. HMRC need them in their entirety to properly assess whether your CT bill has been calculated correctly. So that's a non-starter. You can't reduce the information in those. Full accounts need to go. But your Companies House set, the ones that end up on your public record, those are the ones you can start tapering back. You might hear the term abridged or what used to be known as filleted accounts. And what that means is currently you can sort of restrict things like your director's report, your auditor's report if one's needed, your detailed P&L, things like that. Basically limiting the information that's out there in the public domain on that set of accounts. So obviously if you can make use of some of those exemptions, most companies will certainly want to. So those thresholds that I mentioned, they need considering each and every year. So obviously it's something as a client of ours, we will certainly be asking the question, or if we do the monthly bookkeeping, we'll be well aware of where you're sitting within those thresholds already. But it's something you need to check each and every year. But you do get, I think, a year's breathing space. So if you're small this year, large next, you usually won't have to comply with the full accounts until you've been large for 2 years running. So works the opposite way as well. If you're a large company and suddenly you've had a drop in revenue and whatever else, you'll need to be small for 2 years before you can start reducing the information and complying with the small company regime. So yeah, really key to obviously be checking those thresholds each and every year. So yeah, I guess that's the basics of what they are. One thing I would stress, which is again on the slide there, is the importance of filing these accurately and on time. We will, I think on the next slide in a bit, we'll go through the actual process, the timelines of when they're due. But yeah, it goes without saying, hitting those deadlines, making sure things are submitted, or financial penalties can quickly rack up, not only financially, but directors and companies themselves run the risk of being struck off entirely if you're not filing those on time. So yeah, really, really key. And like I say, we'll go through the dates on that shortly. We've also got something there just to say what is an audit. I know Dom, as I said, on a later slide, will go through the actual requirements and thresholds, but just as a quick point on what it is, just to say Goodwill, we're not a regulated audit firm ourselves. However, with our client base and the types of companies we're dealing with day to day, it is a big thing. We know of the vast majority needs audits. So over the years, we've made it, I guess, a bit of a priority of ours to make sure we've got at least a few trusted partners out there that we can, if the time comes and your company needs an audit, we can go to market, get quotes. And if you decide to use one of them, we've got quite good working relationships to have, I guess, a smooth process alongside one another to get those done and dusted in a timely manner. For those of you that, I guess, don't know what an audit is, obviously you can have internal audits done of your companies. This is very different. It's external. It's an independent audit that's required of your financial statements. The key and their main responsibility is to make sure that what's going out there into the public domain for your company accounts is free from any material misstatements. It's not misleading anybody, and it reflects a true and sort of fair view of your company's position for that year. So yeah, it can be a bit of a long drawn out process, a lot of sampling of data, but it is an important one at that. And like I say, there's certain thresholds as a group that will need considering as to whether an audit each and every year is required, which I said Dom will go on to shortly. But for now, Nancy, if you wouldn't mind just moving to the next slide, we can take a look at the timelines. So for the timeline here, we've used an example of a 31st of December year end, which I think is pretty commonplace in other countries and what tends to be the case with most of our clients in the UK. So a typical year end for a UK company, it will automatically set to, a year on from when you've incorporated. So I set up a company in the UK today. My year end is naturally going to be May 2025, but we can apply to either shorten or extend that to align with a December year end where appropriate. So that's the kind of example we've used here as being your year end is 31st of December 2023 are the ones we're working on currently. I think the first bit before you get to a year end is having the means in place throughout the year of having tidy records and bookkeeping, because even if you've got a small company, things can very quickly, I guess, go awry. We know we've seen that from, clients that have left it till year end to start mopping things up. So having the sort of structure in place to be at the year end and be ready to go is, I think, goes without saying, one of the most important things, and just helps for a really timely process, I guess, once the year end does pass. So yeah, let's say December year ends have passed for most of our clients, which they have. You effectively get 9 months from that year end before these accounts need to be filed with Companies House. So the deadlines we're currently working towards are the 30th of September 2024. Now, that same date is also when your corporation tax needs to be paid, although strangely on the timeline you can see the corporation tax return doesn't need to be filed until 12 months after the year end. Logically, that makes no sense because you can't really pay the right tax without doing the return. So I think that in itself becomes sort of redundant, and typically you'll use the 30th of September for both of those deadlines. So you effectively get 9 months to get all of that done and dusted, which might seem like a long time, but actually it comes about pretty quickly. So getting ahead of the curve and making sure you're ready to go, as the year progresses is really key there. So yeah, general process and filing deadlines. I think, Nancy, if you move on to the next slide, we've just got some key things there to consider. So I think I'll just tackle the left-hand side first very quickly. So that's briefly what I mentioned there is ARD. It's the accounting reference date. So like I said, set up a company today, its year end is going to be May of next year, but you can, request to change that with Companies House. You can shorten a year end as many times as you like, but when it comes to extending, you're limited to doing so only once in a 5-year period. And equally, you can only extend up to a maximum of 18 months. So for example, a company today, I can shorten to December 2024, but I cannot extend to do, one setup to December 2025. So I think, what would that mean? It'd be July would be able to extend to the following year. Anything earlier than that would probably be a shortening to the current December year end. In addition to that, the filing deadline can be a maximum only of 21 months after incorporation. So using that same example of a July year end, if instead of shortening to December, I opted to extend to the following December, my deadline, which this might sound confusing, my deadline would be 9 months after the original 12-month mark had passed. So effectively, that could mean a very, very tight window to get your December 2025 accounts in. I think it'd probably give you, 3 months? It would mean March of 2026 you'd need to get those done by. So that's where people do tend to get caught out. They think, okay, great, can defer doing a set of annual accounts for another year. But what they don't realise is the original deadline applies. You just got 3 months then to do it, which is fine. We can do that. It's just something to be mindful of. Conscious of, the amount I'm talking, but just a couple of other things before I do pass over to Dom. Main one being some changes to corporation tax of last year. And I think this is a biggie, actually. So where before it was your 19%, we've now got a combination of rates. So companies with profits of 50 grand or less, 19, companies over 250, 25. And then anywhere in between, you pay a marginal rate on the profits between the two thresholds to kind of slowly bring you up to that 25% overall. The key thing I would say there, though, is these thresholds need to take into account any of your associated companies. So for the vast majority of you on this call, I suspect that will at least include another company being the parent overseas. It could well extend further to, subs in other worldwide countries. If you've got your parent in Sweden, your sub in the UK, another one, I'm just picking random places, Hong Kong and the US, suddenly you've got a group of 4 that's going to take that 50 grand and suddenly bring it down to what, 12,500 if you divide it by the total number of companies. So that could have a huge effect on the amount of tax you pay. And it is really key that you're giving us or whomever's handling that the full picture of your group structure each and every year as well. And then just below, I've just very quickly touched on some disallowable costs. So I mean, most of you will know, generally speaking, revenue, cost, profit, chargeable corporation tax. There are those some main ones that will crop up that, you can rack up 50 grand's worth of client entertaining. That is not going to, reduce your corporation tax by even a penny. It's added back on when it comes to that tax computation in the same way any penalties, depreciation or non-business expenses might be. So clothes or can't think of any others off the top of my head. I guess legal fees when it comes to taking up new business leases and whatnot, those kinds of things. So obviously we'll review with you as the year goes by and make sure you're aware of those things, but it's something at the year end when you're looking at your P&L and your bottom line profit, these are added back on before your tax charge comes into play. So something, really important to bear in mind. I think that just about covers my bits, Dom, if you wanted to touch
Thanks,
on the
Becky.
audit.
No, that's really useful. Yeah, to the right hand side there. So audit requirements. I think Becky touched on this earlier. So you actually look at the consolidated group figures to see if the UK subsidiary needs an audit. Typically, large companies in the UK or large groups will need an audit. So the thresholds are there on the screen for you. So 50 employees, 10.2 million turnover or 5.1 million assets. If 2 out of 3 of those are breached, you'll need an audit. If 2 out of 3 are underneath, you won't. There are some other exemptions. If the UK subsidiary is dormant or has a UK parent, you don't need an audit, but that's typically not the case for our clients. We're typically looking at that group size. We tend to send out a mail merge every year just to remind clients. And of course, if we look after your bookkeeping and annual accounts for you, we'll have that chat anyway at the year end to make sure we're considering those thresholds. Dormant entities, the very last point on this slide is just making a point that although if you set up a UK subsidiary and it doesn't trade yet, then most of the filing deadlines, even in terms of a tax return, still does apply, and the same penalties apply as well, so to the company or personally to the directors. So just because it's not trading or it's dormant doesn't mean you sort of have to, or you get away with any of the admin around the annual accounts or the tax. It still needs to be looked at and considered. So you can jump to the next slide for me, Nancy. So talking about some regulatory changes, Becky mentioned earlier in the webinar about disclosures that are available for smaller companies. So that will be covered on this slide and how that might change. But effectively, there's a new piece of legislation in the UK called the Economic Crime and Corporate Transparency Act. Now, our governance team, if you're an existing client of ours, will have sent some comms out on this earlier this year. And if you are a client of ours, we'll of course be informing you as things change. But some things have partially come into force. Things like having an address at company's house. If we're your company secretary, we'll have used a generic email address so we can sort of consolidate any communications that come from it. Some things that haven't come into force yet are the disclosures for smaller companies, and they're going to increase. The whole point around that is the feedback so far is that they're too much disclosures are reducing the visibility on that company and what maybe a user would be able to read into those accounts. So these increased disclosures are meant to just better visibility for readers or users of a set of accounts to understand that business better and just increase that visibility really. As things change, like I said, we'll be in touch, but I expect this to be quite a seismic change actually for annual accounts and the process behind it. Thanks, Nancy. Just the final slide. The final slide is looking at some VAT compliance. So I guess setting the scene on this slide is VAT is very complex. These are just some of the basics. If you do have any questions on this, definitely do get in touch. We've got a lot of qualified accountants at Goodwill that can help. And we've also got partners if things do get very niche and specialist that we can introduce you to. But some of the basics is who can register for VAT, the first point. So any business that is intending to trade and has taxable turnover. Intends to trade is a key point because a lot of our clients come to us and they've not set up yet. So you'd need some kind of proof, whether it be a business plan or maybe a draft customer contract that we can provide to HMRC as evidence that the business does intend to trade in the UK. When is it mandatory to register? So you have to register if your taxable turnover is above £90,000 for a 12-month period. You can voluntarily register underneath. I guess the question is, why would you do that? So the key thought really is, who is your customer? So if it's a B2B business and you're selling to another VAT registered business, the fact that you may charge VAT on a sales invoice isn't going to be particularly relevant for those customers because they can recover it. So there's going to be no impact for them. But of course, if you register voluntarily, you'll be able to recover VAT on any expenses you incur. So any rental costs, any staff expenses, any service provider invoices. You might not want to register voluntarily if your customers were sort of B2C, because that would then directly impact that price to the end consumer, maybe impact your competitiveness. So any questions on that, do get in touch and we'll try and apply your scenario to if you need to register mandatory or you should do it voluntarily. The next point is around registering for VAT and raising sales invoices while the process is pending. So there's actually three options. There's two on the page. Third option is don't do anything in terms of raising a sales invoice until the VAT registration is complete. That's probably the tidier, easiest option. But of course, commercially, it might not be viable. You might need to raise that invoice to the customer, in which case there's the two options on screen. So you can raise a invoice for what would be the gross amount, but don't put any VAT on the invoice. And then after the VAT application is complete, you go back and raise a credit note and reissue a VAT invoice where it's split out. The benefits of this one is that you've obviously got the cash up front from your customer. You don't have to get another payment from them. The other option is you raise an invoice where it's just the net figure, but you tell the customer that you're going to come back to them with a VAT only invoice at some point in the future. And then you can raise that net figure, get it paid. When the VAT application is complete, you then raise a VAT only invoice and again get that amount paid. So any questions on that, or if that scenario applies to you, please get in touch and we can advise further. Can I reclaim input VAT before my VAT registration is complete? The short answer is yes. There are some time limits to consider, but we can go back 6 months for services. So for example, if we did a VAT registration for you today with an effective date of the 29th of May, but you had some invoices in, say, March and April this year that had VAT on them, we can go back and recover those. If you sell goods, not services, and you have some stock, we can recover that as well. That goes back 7 years. Just the items in question need to still be in stock. You can't have sold them at the point that you want to recover the VAT. So when should I deregister? So this is sort of on the flip side. If you drop below 88,000, you can voluntarily deregister. So if your revenue is going up and down a little bit. It's mandatory though to stop registering for VAT once trading has ceased or taxable sales have stopped. So if you're going to make the company dormant or you're exiting the UK, we just need to keep an eye on that and make sure we deregister at the right point. I'll skip a couple of these points, but the one to touch on is really the penalty system. I'll just talk about that a little bit because that's changed. It's now a point system that's introduced. You used to just get penalties based on late submissions, and you had interest charged on late payments of VAT. Now you get penalties for both and interest for both. It's a little bit more lenient at the start. You get 4 penalty points until you get penalties start accruing. And a penalty point typically is a late submission or a late payment. So you could almost be late 4 times before you start accruing any penalties. But they are a bit more severe when they start. So it's £200 every time, again, with interest accruing. So again, if we look after the VAT for you, there shouldn't be any issues there. But any questions on that, clients do come to us with penalties already existing and ask us how to help, how to appeal them. Do get in touch. Okay, next slide, please, Nancy. I think that might be it. Perfect, thank you. So just a reminder, if you've got any questions, put them in the Q&A section. We've actually had one come in, and the question is, how do I know if my company's dormant or not? What's the definition of dormant? Becky, I don't know if you want to answer that one. Put you on the
Yeah, it's always a bit of a, I don't know what the right word is. It's always a topic that comes up a lot with us, as people arguing to their blue in the face they're dormant. So general guidance sort of suggests if there's any transactions occurring in the year that need booking in your accounting system, you're usually not dormant. Now, that said, there are some exceptions to that when those types of costs are not specific to trading. So I think you had a couple, Dom, that you've mentioned before. What was it? Companies house fees, and I think the associated fees
Yeah,
of an accountant with those filings to Companies House for a dormant company, they're generally allowable. If there's anything else being incurred expenditure or income wise, typically you're not dormant. So I think, yeah, there's some that catches people out with, bank charges or bank interest being received. Bank interest typically a taxable source of income for your company. If that's the only bit, still probably not dormant. So there's things you can do, like, looking at, I guess, closing the bank account or whatever else it might be to make sure you are dormant. But generally speaking, if there's transactions that are not to do with just the Companies House filing, you're probably not dormant. I don't know if you have anything else to add to that,
no,
Dom.
I think that covers it. And like I said before on a previous slide, if whoever that question came from, or if you are, I've got questions if you're getting close to dormancy and you want to avoid sort of the corporation tax costs and any accounts of cost of full accounts, just get in touch. We can either advise you if you are dormant or not, or even give some advice on how to structure things so you could become dormant. Like Becky said, it could be closing banks or passing that money to borrowing company loan to the parent or something like that. Okay, that's it. No more questions. I can see. So thanks everybody for joining. Like I said, if you've signed up to this, the link will be sent out to you afterwards. And as it says on there, check our website for the other webinars that we've sent out and done on various different topics. But thank you guys. Thanks for joining.
Thank you.